Hello, everyone. For all of you who are joining us today on our housing webinar, we'll just get started in just a couple of minutes. Okay. Good morning. Good afternoon, everyone. Welcome to our Fastmarkets webinar on housing. So glad you could join us today. We have a fantastic panel for this webinar. My name is Jennifer Coskren. I'll be your host MC for the next hour. And we're going to talk housing demand, markets, construction trends, supply side issues. Each of these could be its own webinar for sure. So with that in mind, let's get started. And I'd like to kick off here with introductions. We have three outside experts joining us today. And just a side note as well, for easier viewing on the right-hand side of your Zoom app, if you click View Gallery, you'll be able to see us all on the panel at the same time. First, I'd like to introduce Sean Teig. Sean is a Senior VP of Purchasing for LMC based in Wayne, Pennsylvania, a position he has had since early 2020. Prior to his current post, he held the position of VP Lumber Division. And before that, he held the position of Purchasing Manager, Commodity Lumber. Sean began his career at LMC in 1994 as a lumber buyer and has traded every lumber species in the North American wood basket. So welcome, Sean. I'd also like to introduce Hamilton Fout, Fannie Mae's VP of Economic and Strategic Research. Hamilton is responsible for providing the forecasts of loan volumes and profiles to various business units of Fannie Mae. Prior to his current role, Hamilton worked in the underwriting and pricing division of Fannie Mae, focusing on issues related to credit risk. And Pedro Loureiro also joins us. Pedro is the president of the Nomad Framing LLC, the leading turnkey framing contractor, servicing the high-density multifamily markets in New Jersey, New York, and Pennsylvania. Pedro has over 25 years of experience in the construction industry and has been part of every task imaginable in the framing process. He has been a member of the National Framers Council since 2017, and in 2020 served as its president. So welcome all. And before we get started with our panel, I just want to turn it over to Dustin Jalbert, our lumber senior economist, for a short overview of our thoughts on housing and introduction to our new repair and remodeling index. So Dustin, I'll turn it over to you to help kick us off.
Great, thanks so much, Jennifer, for the introduction. And I will go ahead and share my screen. So let me do that real quick. Okay, hopefully that is visible to everybody on the line here. So again, really looking forward to this panel that we've put together as well. I think there's really a lot of great discussion to be had. To kind of kick things off, kind of want to just give a lay of the land of the residential construction market, where things stand at this point in time, and also to talk a little bit, as Jennifer said, about our new repair and remodeling index in the context, again, of that bigger residential construction sort of picture. The first question I think is important to ask is, why do we care so much about residential construction in the wood products industry? that's probably kind of a pretty obvious question to answer, but sometimes those simple questions are important to lead off with. And as you can see, based on the figure here, residential construction as defined as single family construction, multifamily construction, mobile homes, and repair and remodeling account for about 70 to 80% of wood products demand. And it obviously varies by product type, but generally speaking, wood products is a housing story, right? So that is really what we want to try to understand from the demand side of things, understand the housing side, and that tells us a lot about the trajectory of where we're going in wood products. So, obviously the last 2 to 3 years have been just, tumultuous in terms of the volatility we've seen in wood products. And a lot of that does tie back to this boom in housing activity that has sort of been ongoing since the beginning of the pandemic. I think we're all kind of well aware of the factors that have driven the rise in home sales and housing starts. So I won't kind of belabor that point, but between low interest rates, a massive amount of stimulus to households, kind of the nature of the pandemic, people scrambling for space as they're working from home, their kids are learning remotely, all in the backdrop of a historically tight shelter market, an underbuilt shelter market. All of that has really kind of formed together to fuel this huge sort of surge in demand that we saw, say in 2020 through 2021. Obviously, we're in correction mode now, and this largely stems from the significant rise in interest rates we've seen as the Fed has gone on really the fastest rate tightening cycle we've seen in the modern era since the modern era of the Federal Reserve, all in the context of trying to fight very, very elevated inflation right now. So certainly the home sales side of things have corrected pretty aggressively, depending if you're looking at resale versus new home sales, talking 20 to 30% corrections off the beginning of the sort of 2022 levels. And that, of course, especially on the new home sales side of things, has dragged down housing starts, as you can see to the right. Particularly single family has really taken a hit, again, as a lot of sort of that monthly mortgage payment for prospective buyers doesn't really pencil out now at existing home prices and mortgage rates. So, wood products demand and other building materials that kind of fall at the front end of the building cycle have really been taking a hit, especially in Q4, in Q1 as well, after kind of the tremendous pricing volatility and high prices that we saw, say in 2020 and 2021. So really, the wood products industry in particular is facing an industry recession right now, all because of the volatility in housing. But we spent a lot of time talking about new construction, right? But I think it's really important to emphasize that new construction isn't all of the residential construction market, right? Repair and remodeling is immensely important. As we showed, in the first slide, 25 to 40% of wood product volumes go to the repair and remodeling market. And so really, this is something that is just under discussed. Part of the reason is there's not a lot of great data that covers, that tracks the repair and remodeling industry at a very high frequency level. A lot of folks will either follow the Harvard Joint Center on Housing Studies, sort of LIRA, the leading indicator of remodeling activity, or will follow the C30 residential construction data, which has baked into it sort of residential improvements. Both are useful sort of data points to follow, but like any data, there are a number of problems and limitations with those indices. I'm not going to kind of go through and decompose all those issues for the sake of time, but I think the one thing to note about those indices is they either report or model dollar sales of repair and remodeling activity, which, sort of pre-pandemic was not a big deal because in the context of a 2 to 3% inflation environment, if you're really trying to understand the underlying volume of repair and remodeling activity, you could back out that 2 to 3% and you could kind of get a rough estimate of what, sort of the hours of construction put in place, if you will, in the repair and remodeling space was trending. But certainly today, over the last 2 to 3 years, in the context of building materials inflation pacing 15, 20, 25% year over year, you are really masking the underlying trends in repair and remodeling activity volume. So this whole sort of issue kind of was the main driving factor why we decided to create our own index, which we're calling the Fastmarkets Repair and Remodeling Index. And between what we've been seeing on the wood product side from a volume perspective and some of the other alternative indicators we were following, we created a composite index using some basic statistical analysis, principal component analysis, and really the model is driven by remodeling contractor hours worked reported by the US Census, building materials sales adjusted for inflation using census data as well as Federal Reserve data, and also Google Trend searches for key renovation and home improvement sort of activities. And a big shout out to our economist, Emerson Parody, who's spent countless hours working on this. He's really done a lot of the legwork for developing this model. And I think he's really come up with something very useful for the industry to start tracking. And if you look at the index on a seasonally adjusted basis in purple, based on the purple line, solid purple line, you can see that, to no surprise, there was this huge spike in remodeling activity at the outset of the pandemic. No surprises there. That's also pretty consistent with a lot of the alternative measures of remodeling activity that people follow. And you can even see the spikes that occur around when the rounds of stimulus checks came out. Where our kind of index starts to kind of differentiate from the rest of the market is really in the spring of 2021, where we saw a massive drop off in activity, which, funny enough, was also coincided with what we saw as a slowdown in volumes moving through the channel for wood products and a major correction in wood products pricing. All the while, new residential construction was really taking off. So it really does emphasize R&R really does matter in the grand scheme of wood products and building materials. And you can see, what are the factors that are probably driving this correction that we're seeing in actual underlying volumes of construction put in place. It probably has to do with a return to the service side of the economy, right? In terms of normalization, more people getting vaccinated, feeling more comfortable going out to restaurants and bars again, going on vacation. That clearly is a huge factor for the pivot that we saw in 2021. Probably some demand destruction. Very high building materials inflation meant that what your project budget could get you in 2021 was a lot less than it could get you in 2020. And those are, the two key factors. There's probably other factors as well, like the sort of boom and bust of the cash out refinance market. You have stimulus checks and pent up savings wearing off. And as you can see, our index continues to kind of trend down more towards the longer term secular trend that you see pre-COVID, pre-pandemic. So, we think repair and remodeling activity based on our index, again, in terms of the volume of activity, parsing out that inflation, is probably maybe 5% above pre-pandemic levels, but we're still well off of, the very, very elevated levels that we saw early in the pandemic, driven by this sort of DIY over the shoulder boom of home renovation activity. So we're pretty excited to be launching this index. I think it's going to be a really useful tool for the market. No index is perfect. We're probably going to refine the methodology over time, but I think, for a space that's so important for the residential construction markets, we're glad to be adding some more visibility on what's happening in a high frequency way. And as a side note, we are going to be sort of publishing this in our lumber and panel commentary starting next month. So you'll see that for those of you who are subscribers, and you'll have access to the full data back to 2006. And then we'll also be reporting this in the Random Lengths publications on a monthly basis as well, in more truncated format, probably 12 to 18 months of data. And we'll also have a white paper coming out in the next few weeks if you really want to get into the nitty gritty of the index. So to kind of put this in a bow here, thinking about what's happened in residential construction, broadly speaking, both new construction and repair and remodeling, we clearly are seeing things cool down from the very elevated sort of pandemic levels of activity that we saw in, say, 2020 and 2021. And that's put a lot of pressure on the front end of the build cycle from a building materials perspective. We're calling for wood products demand to be down by sort of 4 to 6% in 2023. So it's going to be a tough year from a mill perspective, but it does seem like the leading indicators are starting to bottom out. Whether you're looking at the home sales data, we did see a bounce in new and existing home sales recently, as well as our repair and remodeling index from a volume perspective does seem to be leveling out. The question becomes, how fast will we reaccelerate, and the timing of that reacceleration in demand, and really how do we adapt with these headwinds with affordability, high interest rates, and of course, some of the recent banking stress that we've seen in the market. So with that, I think that's a good segue to pass it back along to Jennifer and to kick off the panel.
Thanks so much, Dustin. Yeah, we're really excited to be able to introduce this new R&R index. It's, so important in times of volatility to have, more data, more information. So thank you so much for introducing that. As I told our panelists in an initial meeting, I'm really excited to be chairing this session. I certainly could talk housing all day. It's one of my favorite subjects. And so what I'm going to do here is I'm going to, just ask some questions of our panelists for the next 30 minutes or so. And then I'm going to turn it over to you and the audience for any questions there. And to open up the conversation, the discussion, I first wanted to kind of talk about demand and in markets. And so, to all our panelists, how does housing demand look, say, compared to where we were last year? From your perspective, weakness, any particular weakness? Is there any strength? And maybe more broadly, what's keeping you up at night when it comes to your business and housing? And again, I'll throw that out to all the panelists. Get your take.
I think it's pretty apparent from our standpoint. So we're looking at the market through the eyes of retail lumber yards or LBM yards primarily, and we can definitely notice there's a slowdown for sure, just simply by the total lack of takeaway. But it remains uneven right now. What I mean by that is that the market, as far as volume, pricing, it's still going up and down. So I think the market is also still trying to figure out exactly where we stand compared to last year. I think we could easily point to single family homes at this point and say we know that they're slowing down, but there are other segments of the market that seem to be staying pretty well afloat right now, particularly multifamily and R&R. So it's a little bit uneven. As far as what keeps me up at night, it's all the forecasting you try and do and try and figure these things out. You always have a shoe that you're waiting to drop. Mm-hmm. And here we have the banking stress, as Dustin referred to it. And, you just never know what's going to come down the pike that might just upset the apple cart.
So I'll jump in. Go ahead, Hamilton.
No, Pedro, go ahead.
All right. So on the multifamily side, because that's really what we're focused on, what we're seeing is still a pretty good pipeline. We have a current backlog of roughly 12 months, so we're pretty comfortable where we are right now. We haven't seen a significant slowdown, and we actually polled the members of the National Framers Council and the members of the SBCA, which exceeds 800 members collectively. And across the board, 20% of the membership reported a modest slowdown over the next 12 months. 30% reported a modest growth over the next 12 months, where the rest of them were kind of flat, which indicates pretty much the market is flat over the next 12 months. One thing we have seen is the smaller developers. They're starting to pull back on projects. Banks are now requesting 50% of cash, so they're only giving 50% of the loan, where it used to be 70 to 80%. So the developers are looking to have to come up with a lot more cash up front in order to get these projects to even start. So we do believe over the next 24 months, we may see a slowdown in multifamily, but more so on the luxury multifamily sector. I think the affordable multifamily sector will see an increase because at the end of the day, there's still a significant shortage of housing units in the United States. So some of our customers, what they're doing, they're already kind of pivoting to the affordable housing over the luxury housing. And I think that's definitely going to be something for us to keep an eye on over the next 24 months.
Yeah, I think the way we look at it is from the perspective of the home buyer and what's going on with mortgage activity. I think as Dustin laid out, we've of course been tracking the contractions that have happened in the existing sales market, the new home sales market, and then some of the bounce back that we've seen recently. We're really looking at kind of where affordability is, and the way we typically track this is we look at the homeowner, the potential homeowner who's out in the market. What fraction of their income is it going to take to keep up that principal and interest payment? That was at 20% or so pre-pandemic. It was pretty, it would move up with home prices and would move up as rates picked up, but really saw a tremendous jump here over the last year. It's now at 33%. So even with some of these rate drops, right? We saw a mortgage rate at the end of last year at 7%. It's come down. We've seen it as low as 6.1%. And there's been some action where people have jumped in and bought homes. But largely, we look to be kind of in this moment where sales are going to be pretty depressed, right? And just kind of listen to some of the numbers people are throwing out, we're pretty similar. We see the contractions roughly 20% in new and existing last year. We think we're going to see probably not as big a contraction in new home sales because there's just starts that have happened that are going to carry over. We see those down roughly 5% or so in 23. But existing sales, we think they're going to see another contraction somewhere around the order of 20%. We're around 4 million units, 4.1 million units. You can compare that to where we were in the financial crisis. That's about the worst we saw right in the 2008, 2009 period. For us, and I really appreciate the kind of renovation perspective. For us, we look at existing home sales really as kind of existing homeowners releasing that stock. Given where interest rates are, given the fact that a lot of people have renovated, given the uncertainty, and Dustin, you highlighted kind of what's going on in the banking segment, there really seems to be kind of a reluctance for existing homeowners to release that stock. I think that's what we're thinking about for us. And I know we're going to get into this. Supply is really the limiting factor, whether it's supply of new units or whether it's folks releasing maybe their first time home buyer segment and moving up. I think they've been the story the last 5 or 10 years. They really, I think, are kind of coming to a head again, as we're looking at our outlook for 2023.
And Hamilton, that's a nice segue into the next question I was going to ask. For you, in terms of, obviously, as you say, there's kind of a problem with the housing market, and you've got, what are we calling it, the golden handcuffs, right? That people have got these subpar mortgage rates, and it's just sort of kind of grinding the resale market to a halt. And just out of curiosity, one thing that could obviously trigger some more product, more sales coming to market, more homes coming to market, would be kind of this sort of alleviation in mortgage rates. In my mind, I always think about mortgage rates maybe below, 5.5% is when you might see more homes coming on. Do you track, or do you have kind of where you see mortgage rates, say, by year end?
Yeah, and I think we all have been tracking mortgage rates and watching them kind of bobble and watching
right.
the Fed funds rate bobble. Our basic view when we look at mortgage rates, we look at where treasuries are, right? And if you look at kind of what happened over the last couple of weeks, Treasury was at 4%, 10-year Treasury was at 4%, earlier this month. It got as low as 3.4. It looks like it's stabilized a bit. And then we look at the spreads over that. And so if you look, of course, because of inflation and other drivers, 10 years pretty elevated. We see that coming off a little bit as we think the Fed will be able to successfully fight down inflation by the end of the year. So that'll push mortgage rates down. Recent read of mortgage rates last week was 6.6%. So if we just kind of start there and think about, okay, partly that's going to come down because of the 10-year. But the other thing, and we glossed over this, I know, Sean, you answer this, what keeps you up at night? One of the things for folks that track the mortgage industry that is still a head scratcher, spreads of the mortgage rate relative to the 10-year are gigantic. That's particularly true for the spread of the MBS rate over the 10-year. So that has to do with volatility. It has to do with liquidity. It has to do with the Fed really taking a step back. Now this whole banking sector item has come on top of that. So we look at that, and for a while we've said those spreads are pretty wide. We see those coming in. I think lender spreads have already come in a bit. We see that coming in, but again, a lot of volatility over the past couple of weeks, I think, is probably pushing that out a bit. So our forecast, typically, if we start somewhere like 6.6%, we see things coming in. And I would say, rates starting to trend towards 6% by the end of 2023. But I don't, if 5.5 is the kind of the number we're looking for stability, I think that's probably a ways off unless something dramatic happens with inflation in the 10-year or with mortgage spreads.
And Hamilton, you spoke about the kind of the sort of the volatility in the banking sector right now. To all of you, I know it's so early, right, with what's happened with Silicon Valley. We're still all processing what this means for our business, credit markets, lending. I'm just wondering if you've heard anything, you've seen anything in your data, or you've heard anything from your customers or the folks that you work with about concerns or what you're already hearing perhaps about the kind of upheaval we're seeing of the last couple of weeks with the Silicon Bank failure.
Yeah, I would just comment what I'm hearing from some of our customers on the multifamily sector, that the regional banks account for 80% of the lending for the multifamily sector. So those are the banks that are being hit. Specifically in our market, Signature Bank out of New York, they're the ones that really were funding a lot of the projects in our area. So when there's a run on that bank, on those regional banks, it's definitely going to put pressure on the multifamily. So unless developers have a significant amount of cash to get the projects off the ground, they're not going to be able to get them off the ground.
Sean, have you heard anything from your members, from your within the industry about any concerns so far?
I really haven't heard a whole lot. Everybody, of course, is talking about it. There's definitely concern that, that what we just went through the past couple of years with supply chain issues, is there anything that's going to come as a matter of fallout from any of this? So I think at this point that we're all looking at it from more of a distance and just saying, waiting to see what's going to happen. But it doesn't seem like it's materially impacted anything that we're doing yet, but it's certainly a topic of conversation.
Yeah, and Jennifer, I could just add, because one of the things that we typically try to frame up our view of housing and home prices and sales and the like with a macro forecast. And, since April of last year, we've saw inflation picking up and thought about, well, the Fed really is going to have to lean against this. They're going to have to raise the rate pretty dramatically. We knew they were talking about kind of changing the stance on portfolio. So we have thought that the economy, like a lot of folks who track this, that the economy would be in recession, in the second half of 23. So in some ways, when we start to see this unfold, maybe we didn't know that was going to be the mechanism. But I think a lot of folks who track this say when the interest rate needs to come up this quickly, things can break. And so I think in some ways for us, we say, okay, yeah, this is pretty consistent with the idea that there might be a recession. I think the thing that we learn about, and what I've heard others who talk about this and kind of look at the macro picture, there really now is the risk of a harder landing, I think, has increased. And the other thing I would say is there's some things even worse than harder landing. You may have a recession that still has some inflation there. I think that trade-off that the Fed is facing right now, trying to keep the financial system stable, still keep the economy from contracting too much, and fighting inflation really has come to a head. So I would just say, that's not a definitive answer by any stretch, but that's basically the things that I'm hearing kind of in that macro forecasting space, is that people are starting to get a bit more pessimistic about the economic growth potential given kind of some of the uncertainty and instability.
Yeah, that's something Dustin and I were chatting about the other day. We were talking about this. We said we've been monitoring so much, the consumer and what impact rising rates will have on, consumer spending and on the housing market. There was a little, not little, but kind of a trouble brewing that we weren't aware of. So certainly, as you say, as rates rise, something breaks somewhere. So Sean, I just wanted to ask you too, talking about rising rates, for your members kind of focusing on that custom home building market, how impacted has that business been with the sharp rise in mortgage rates? Are you seeing any kind of regional anomalies there in terms of housing demand and construction?
Sure. Yeah, we definitely have dealers that participate in all the various segments, but custom homes is certainly our forte among our dealers. And I would say that custom home building right now remains a very strong area. So if we look at regionally, for example, if you take a look at some of the housing start numbers that came out recently, New England goes and surprises everybody by having a higher start number by percentage than other places. And I think that's probably an indicator that custom homes are doing pretty well in those markets. Generally speaking, a custom home buyer is likely a little bit less impacted by changing costs and some of the other things associated with buying a home. And if they want that house, they're just going to go ahead and build that house. I think we'd see the same thing in the Pacific Northwest. There's been a pretty good custom home build in the Pacific Northwest. The areas that we would most associate with large tract builders, custom homes are a little bit less impactful there. They probably get lost in some of the numbers in those markets, but certainly custom homes are doing well, at least for right now. And what our dealers are telling us, they think that'll continue.
Yeah, I had read something that some of the home builders that cater to the middle market were having these high cancellation rates, and these custom builders were doing a bit better, part also due to like the high loan to value, but the high amount of money that has been put down in the house, that there's more for them to lose if they cancel the house, etc. So that also kind of helping to prop up that higher end market too.
Yeah, I would definitely agree with that.
So I wanted just to pivot right now to, kind of discussing demographics, kind of the work from home, affordability issues. Sean and Pedro, I just wanted to ask, we think about millennials, what challenges, opportunities has this millennial boom meant for your business, maybe the building material and construction industry as a whole, because we have this kind of record number of prime-aged adults kind of hitting at the same time. So I'm just wondering what opportunities or challenges you found with that, say over the last, maybe a couple of years or last year even.
Sure, I can jump in there. So, it's kind of funny. It's actually impacted us unevenly. One of them I can kind of talk about a little bit is a very local to us, which is actually our company. When we had a return to work back in September of 2021, we were impacted by folks that preferred to work from home or have some other type of remote work environment. And maybe interestingly, although it's a small sample size, the group that tended to most want that arrangement were 30 to 40-year-olds. And that would be the early edge of that millennial group. And that could be a host of reasons. Perhaps they felt they were pretty far ahead in their career at this point or didn't need the structure of an office and that kind of thing. But then conversely, we also have a next gen coming up through our dealer base. So all of those independently owned family lumber yards, a lot of that next gen is coming through now. That's also the millennial age. They're super highly engaged. I think them, along with the Gen Zs right behind them, are probably going to do a lot to change our sensibilities about how we go to market, what we see in the market. And I think we'll also see them bring along a big technology gain. That's certainly something that kind of lags in the construction industry relative to other industries.
Yeah, and I guess from my vantage point, the way I see it, it's definitely helped our business because of the multifamily sector, right? So a lot of our customers are building these large apartment buildings that have amenities that really rival hotels, and that generation has definitely been taking advantage of it and enjoying it, right? So for us, being able to be in a market where we're right between Philadelphia and New York City, there's definitely a lot of offerings for that generation, and they've been able to definitely fuel the amount of products that we've been able to put up.
Great. And Hamilton, I wonder if I can ask you this. Numbers get passed around quite a bit when we talk about obviously the millennial boom that has been ongoing, and how underbuilt we really are, right, in terms of markets. I've read various statistics over the years, some more on the high side. Do you have a sense, or does Fannie Mae look at that kind of approach? I guess particularly when we're talking about affordability constraints, how underbuilt we might be.
Yeah, I mean, we definitely look at this. I think when we were looking coming out of the crisis, the financial crisis, just tracking how home prices started to pick up and we weren't seeing the supply response and really kind of building a gap there. We do some analysis around kind of household formation and kind of tracking construction. We put a piece out late last year. The number we put out for the shortage of units, and this would be, you know, multifamily and single family, so rental or owner, was at 4 million units. If we look at kind of where we think household formation is, and obviously for those who try to do this, this is a very imprecise science, but just giving you a few numbers to think about, you know, we think maybe 1.5 million households per year are coming up and being created. So if you put all that together and you think you've got 4 million units and you want to try to build, you know, 1.5 million units per year, and maybe you want to give yourself 10 years or so to try to get that gap of 4 million units, we're thinking, you know, you probably need something close to 2 million units, maybe 1.9 million units. Again, that would be multifamily and single family starts. Not seeing anything near that. You know, if you look at our forecast that we put out there, again, with the initial comments that I've made about kind of where we think things are as we're kind of entering in a more recessionary environment, we're really closer to like 1.2 million units for 23 and 24 annually. And then, you know, if you're interested, that roughly 800,000 of those being single family. So we see the gap, and I know we've got some experts on the call. I really want to hear from them, kind of, you know, how that gets plugged or what their thoughts are. But I think that's really where we are. That is going to continue to be an issue. We don't see that kind of solving itself anytime soon.
Yes, I mean, one thing that I've been thinking about when you talk about, you know, housing and the headwinds, and, you know, if you look at the demographics, you know, that millennial generation, that real big surge might be a little bit more behind us. But so the medium term, I mean, excuse me, I should say the near term, obviously the headwinds are strong. But over the longer medium term, yeah, to your point, there's still so much supply that we need to catch up on. Absolutely, that we're just that's just speaking to the low level of existing inventory. I just took a look at that number, and it's still below 1 million units in the existing inventory, and that's 30% below where we were right before the pandemic. So we're not catching up yet. And I guess that speaks to you know, the affordability issues. Obviously, affordability has huge societal implications, and the answer to our issues with affordability would be to produce more construction picking up. But obviously the answer to that, more supply, but that's going to be a struggle with where rates are heading. So I'm just wondering too, any thoughts on, you know, how we handle affordability? Is there anything we can do on the construction side, say, offer a little bit of hope on affordability? It seems to me that on some level, development is getting harder. There's just more environmental concerns, more regulations. So I'm just wondering, maybe Sean, Pedro, you know, where do you see, is there hope for affordable housing, and just given how tough it is for development?
Yeah, I mean, I think there is. And like I mentioned earlier, some of our customers are already starting to pivot into the affordable housing sector. So, you know, I think, you know, the government's definitely going to have to step in as well to be able to close that, to bridge that gap. But I think a lot of people are already starting to focus on that, because again, I guess the silver lining with all the headwinds we have facing is that at the end of the day, we have a significant shortage of housing, right? So we need to solve that problem. So I think it's definitely going to take some assistance from the federal government for us to be able to close that gap. But I think there's people that are already starting to look at that.
You know, the market always finds a solution. Every market finds a solution to a problem. It may take a while in the housing industry. You know, the near term one we would look at right now is look at the rise of multifamily. So that might be the best answer that we have at the moment, of trying to find some way to create some type of affordability. So we're seeing multifamily respond in a big way right now, as Pedro was just mentioning. Longer term, there's probably other things that can happen. Some of it, Jennifer, is going to be that governmental piece of it, right? There's so much regulation out there that really hinders home building for builders. Something's in some communities where housing density, you have a 1 acre lot, but it's limited to a single family home. Would it be possible to put, a small multifamily there, 2 or 3 units, just to spread that cost out over 3 different people? It's not really amenable to a lot of communities. They don't really want that, but that might be something that could change. And likewise, we continue to see in the background the rise of offsite building. We see component manufacturing and those types of things. And I think they'll continue to try and find their niche in the market to try and drive affordability. But there's going to have to be some societal changes there too. Right now, most Americans don't want standardized housing to a great degree, right? They want something a little bit more customized or a little more personal to them. So that's probably going to take a little bit more time. But if there's enough pressure to find affordable housing, I think we'll find a solution.
Hamilton, anything else from Fannie Mae's perspective in terms of affordable housing?
Yeah, I definitely agree with Pedro and Sean that it really is, about kind of the ownership stock, but then also in the multifamily segment, are there affordable rental? That's certainly part of the solution. I think when we look at it more from, like single family ownership, we look a lot at manufactured housing. We look at inclusionary zoning programs or housing programs. And, Sean, I think to your point, how do we build up density, even with existing single family stock, accessory dwelling units, just other ways to kind of increase density there. The other thing, Jennifer, that you touched on that we were doing a lot of analysis on this prior to the pandemic was around, what we were talking about with lock-in, in the sense that really, if you look at what was happening coming out of the financial crisis, the millennials and younger people and younger homeowners and even renters were locating in urban areas, right? We were seeing a move back into urban areas in the centers of production, and it was putting a lot of pressure, of course, on supply. And they were moving to very inelastic supply markets, like the tech markets. And there were some echoes there. I mean, they moved to Denver and those places got inelastic, and they moved to Seattle and those places got inelastic. So the pandemic for us offered, at least partly starting to be a solution, right? That you had the ability to work maybe away from the center of production and be able to kind of start to, locate yourself in places where it was easier to buy, right? Phoenix, I think, is really a poster child as a market for that, because they would, even today, if you look at price points, Phoenix is at like 400,000 for like, let's say the median home price. And if you're at San Francisco, if that's really what you're thinking about, that's at 1.2 million. So that's still true. Even if you have a low rate in San Francisco, you could give that rate up and you could move to Phoenix. But I think, like Sean, just hearing your anecdote, and we're seeing the same thing. And DC is kind of late to the game, I think, of getting back in the office. It really doesn't seem to be at least to the degree we saw in the pandemic, a permanent shift. And so I think the question for us is, is there a way to get more mobility? Is there a way to get people to be able to kind of sort out of some of the more expensive markets or move further out in a metro area to kind of get them to buy in places that are a little more supply elastic? I think that's part of the solution over time.
Yes. I mean, I think too, what's been interesting is what's been key to that is this kind of work from home. And it seemed like we had this, wondering if this was going to be a permanent thing, all of us working from home full time. And what we've seen is that it's going to be probably more of a hybrid approach where we're going into the office, maybe say 2 to 3 days a week. And so I think that helps on the margins, that maybe you're willing to endure, this kind of slightly longer commute if it's only 2 or 3 days a week. But it perhaps doesn't answer fully where there's parts of the country that, you can build much more cheaply, but are just not super attractive from, a development and from a, kind of amenity standpoint. Pedro, I just wanted to ask you to kind of pivot a little bit. We're talking about affordability and how some of that might be alleviated with the multifamily market. We've seen that one topic that, Dustin and I talked about quite a bit is just the historic number of multifamily homes that are currently under construction. I think you'd have to go back somewhere in the 80s to see this kind of level of construction. Can you talk a little bit about maybe what some members at the Framing Council are seeing as maybe still some key supply constraints that might be kind of making it tough to complete homes or maybe even start new ones outside of, say, the financing issues?
Yep. So I guess the good news is for us framers, the constraints we had in the marketplace have pretty much gone away. There's not significant long lead times in any of the softwoods or engineered wood anymore. So it's pretty accessible, especially since the single family market started to slow down. Everything became very accessible. So that's the good news. I think from what I hear from our customers, what's happening is, after the framers are done in the project, that's where the constraints are. There was a significant constraint with getting roofing materials, specifically the tapered roofing insulation. So a lot of projects were framed, but they couldn't get them on the roof, so they couldn't progress, with the mechanicals inside the building. So there was a big issue with that a couple months ago. And I think right now the biggest single issue is switch gears. Our developers can't get switch gears to basically power the building. So if they can't power the building with temp power, they can't get permits. There's buildings that are basically stuck, where their lead times for switch gears go from 20 weeks to 80 weeks overnight. And that's what I keep hearing from all of our customers. That is the single biggest challenge. There are smaller challenges, when it comes to rooftop generators or big condenser units for HVAC equipment. But it seems like they're kind of sorting themselves out. And some of our clients are trying to get ahead of it. I know one client of ours, he was telling us that, the second contract he awarded on this said project was buying all the appliances. Typically you buy out, the site contract, then you buy out concrete, then you buy out framing. Well, they ended up buying out the site contractor, then all of the appliances, put them in storage, and then went to concrete, right? Which is unheard of. But that's what's going on right now. It's beyond our scope.
Right. And just I don't know if this is an interesting stat I was reading, because one of the questions I have for you, has the project multifamily project composition changed in the last few years? And one stat I was reading from the census was that if you look back to 99, if you look at the number of units in a building as a share of total starts, so the number of buildings with 20 or more units, number of buildings under construction, only about 37% were these larger buildings. When I read the stat for 2021 and 2022, it was 85% of like construction starts with 20 or more units. Are you seeing that as well? Are you seeing these sort of larger developments taking, coming up more frequently?
Yeah, absolutely. Definitely in our market, we're seeing that, where, I would say 5 years ago, the average size project we were doing was roughly 100 units. That average size is now 300. We got projects that are up, 670 units is the largest project we have currently.
Wow.
And, a 400 unit project is typical nowadays.
Wow. Yeah. So that was a fascinating statistic when I was looking at the census construction starts, and I said, wow, that literally doubled since 99, that share of larger buildings.
Yeah.
Sean, a big question too in the wood markets right now, how much inventory is on the ground at the moment and whether kind of it's sufficient to meet current demand levels. Do you mind just talking through what you're seeing with your members? And are there any structural changes with how inventory is managed in sort of this post-COVID world, given all the crazy volatility we experienced in 2020 and 2021?
Sure. So I think right now, because we're in a bit of a pricing recession, right? Things are coming down or have come down so quickly, especially in wood products, but really across almost all building materials at this point, that we're seeing inventories are fairly light in the field, at least at the retail level for sure. And that's just a way to kind of hedge against, further weakness or a little uncertainty. As I mentioned earlier, it's uneven a little bit. We still do see some spikes up and down as far as how the inventory is getting handled. But, inventory and how it's handled, I would say on the retail side as an indicator would be, you have sort of just in time, just past time, and just get it. And that's bookended by times where inventory is tight and prices are going higher, or inventory is plentiful and prices are going lower. And over the past couple of years, we really lived in a just get it, right? Nobody really cared what the price was. It didn't really matter. We just had to have it. And right now we've kind of already slipped back to a just in time market very quickly, almost more quickly than I would have anticipated. The comfort level to go back into a just-in-time market is there. We're not quite ready for a just-past-time market because there's things are still tenuous, right? Certain things can change on a dime, and nobody really wants to go through that pain we just went through where they weren't able to get products. But probably the biggest structural change really is, I would say, generally how customers view the supply side. What we've seen is a lot more dedication to particular suppliers, meaning let's get an alignment and let's stick in that alignment through good and bad, ups and downs, because ultimately my long-term relationship with that particular manufacturer is going to pay off. And we did hear for a lot of years, Chicken Little, like, oh, someday it's going to be hard to get, and it never really came to it, and all of a sudden it did. And those folks that kind of found that they had some really good, strong relationships that have been in place for a long period of time, that they've actually committed some business towards, really benefited over those that took more of a shotgun approach to the market in general. So I think we're going to see that type of structural change stick. And I think that I'm hopeful that long term, we're going to start to see ways that we're better able to handle inventory from the forest all the way into the lumberyard.
Right. So we did have one question. I just wanted to, Hamilton, I believe it's for you. This question that just came through feels like something is missing. The pent up demand estimate for homes, such as the 4 million mentioned. Could it be that existing stock will last a bit longer with R&R than we're assuming? I guess that's the other question. I did read an interesting stat about home ownership recently, that the same house tenure has doubled since 2005. So it's 6.5 years to 13 years. So certainly would suggest that perhaps more renovation spending could help here in terms of existing stock lasting longer if we're renovating more.
Yeah, and in some ways, and a lot of us see this, right? And you look around your own neighborhood, and you'll see. And so I live in Montgomery County in Maryland, around the DC area, and you'll see someone buy a house, and then they'll rip it down, but they won't rip it all the way down. They'll leave like a wall, or they'll leave some part of it. And I think you guys really being the experts here, that to me, I guess, is counted as a renovation. It's not really counted as a new construction or a new unit that's brought in. And so if I'm reading that question or understanding that question, kind of what they're looking for, yeah, part of the, what we think is, well, that new unit wasn't created. Well, it was. I mean, there was a new unit created, may not hit the statistics in terms of a start or, a new home sale or that, but it would kind of effectively represent a new unit of construction. And then to your point, Jennifer, I think the other thing that we have thought a lot about when you have people, particularly, just imagine this scenario of, someone, just a first-time home buyer entering the market, 20 years ago, they go and they buy a first-time, a house that has a certain footprint. The typical paradigm was they would own it for a few years and then trade up. With the rise of renovation, again, we were looking at this a few years ago, they really are able to convert that first-time home buyer unit into their kind of trade-up unit. And in some ways that works for the existing homeowner, but I think what it does is it deprives the first-time home buyer market in some sense of that unit. And I think that's really, if you go back and you track what's happened with affordability, there are a lot of drivers here, but affordability has become really crushing in the first-time home buyer segment, or the lower 1/3 price tier of single family housing, of course, for all the demand items that we mentioned with the millennials and even the generations coming after the millennials, but also because that's not where units are typically built. And that's also a place where I think renovation, and to your point, Jennifer, people staying in their home longer, has left supply more constrained than other segments of the market. So I think all of those things, definitely not a great answer, I think, across any definitive answer, but those are definitely things that are kind of in consideration.
I just wanted to touch to Pedro. This is when we talk about housing and challenges. One interesting segment of the market that we talk about, not only about affordability, but building more sustainably. And you and I were chatting a little bit about seeing some growth from cross-laminated timber, mass timber systems in multifamily. I'm just curious, how fast do you see that potentially growing? What are the challenges there? It's, we see, looking at projects, the level of projects using CLT mass timber has certainly grown, say, in the last decade. But I'm just curious, how fast do you think it will grow, say, in the next couple of years? Because it gets back to building more sustainably, but also potentially building with fewer workers too, that we can take some of this off-site. I'm just curious to get your feedback on that.
Yep. So yeah, we're definitely seeing it, the significant increase. I think regulation was one of the big pieces. New Jersey, for example, just adopted new code 3 weeks ago that now allows us to build up to 18 stories, where 4 weeks ago we weren't able to with CLT. So obviously there's now the possibility of building a tall, mass timber structure in New Jersey, and I'm sure that's what's happening across the country. The fact is that a mass timber building does perform better than a concrete and steel building. The fact is that mass timber building is sustainable, definitely a lot more sustainable than a concrete and steel building. So we do believe it's the future. I do believe it's the future. The issues, I think, still remain that there's not enough manufacturing in the U.S. The manufacturing of mass timber in Europe and Canada dwarf the capacity that the U.S. has. So there's issues of bringing the materials in, because there are finished products. A lot of it's still coming from Europe, and you got to ship it across the Atlantic. So it causes some significant issues there. But the other piece is the glulam. So a lot of these CLT floors need to be held up by glulam posts, and again, there's not enough mills that they're producing them right now. So I think it's going to take some time for it to ramp up, but it's definitely moving up. I'm actually going to Portland next week for the Mass Timber Conference. It's got record attendance, and it's got people coming from, I think, like 36 different countries. That's one of the emails I saw this morning. So a lot of people are looking into mass timber, and I think it's definitely the way to the future.
It's a fascinating topic. It's one I've been, kind of trying to dig into a little bit more. And certainly it's a recent survey I read suggested that, awareness of it is growing really strongly. It's just the industry still has some, challenges ahead in terms of, as you say, with production and all that. So, we have about 5 minutes left. I just wanted to ask a question for all of you, just as kind of wrapping up. What is the most surprising change you've seen in the U.S. housing market, say, since you first started your career? Anything kind of stand out to you, in terms of the changes that you've seen in the industry since you started your career?
I think for me, I'm a little bit more removed from the actual home building, but just kind of watching it through the eyes of our customer base and how they're impacted. Really, probably has been what I touched on earlier. Just the how much we've grown regulatory roadblocks in some cases to being able to build, and it's what it's ended up doing in some ways. So if you take California or you take Seattle or Washington State, where they have pretty high regulatory costs that go into it, it's kind of held up the price of the house on the resale as well. So everything stays very inflated. It adds to maybe a little less density or less capacity to be able to build in those particular areas, and kind of creates a conundrum to how do you find affordable housing in those particular markets, given all of the hurdles. And I started in this in the early 90s. And I don't think we saw the regulatory. I mean, look at Texas is still sort of that way. They're able to kind of build a little bit more freely, I think. So that's probably what I've noticed the most.
And for me, I think from just the perspective of, starting on the single family side and looking at credit data and trying to figure out what was going on with regional markets, and, I started looking at this stuff back in 2010. really the last, let's say 12 or so years, I've seen a lot of data come on the scene, right? I mean, so if we're wondering about what's going on with certain markets, you can look at Redfin, you can look at AEI. People are putting out a lot of data that's available to kind of track. So that has been pretty interesting. But then there are things that come up, and we were talking about this earlier, kind of getting ready for the call. We start to hear, well, builders are giving rate buy downs, and you try to find a data point on that. And John Burns has a survey data point, but those data points are hard to come by. So I feel like there's a lot of data, but in the end, the market and the world surprise you, and you've got to try to do the job of an analyst or an economist and dig through and try to find that data. So it is nice to have more data, but sometimes that one data point you need is still kind of just out of reach.
And you can't rest till you find it.
Yeah. And I think also your guys R&R index too, right? And I pinged you guys earlier for that. That's very interesting. Something, we were trying to find some measure of this a few years ago. So, very excited to see this and kind of see if we can consume it and kind of link it up with some of our views.
Great. Thank you.
For me, I mean, I'll get my little soapbox here for a second, but I think, keep seeing articles and reports how construction industry needs to be fixed because they're not as productive, or they haven't increased production, or and I started the industry 25 years ago, and I think that's a little flawed of the way it's looked at, right? We're building a much more complex product today. We're building it better. We're definitely building it safer. So the product that we were building years ago, 25 years ago, not the same product we're building today. And we've adapted to that, and we're still being able to produce the same amount of square footage and product the way we did then. We keep hearing the old saying, when we look at manufacturing, they don't make them like they used to. And on manufacturing, it's definitely true. They don't make them like they used to, because I believe they are cutting corners, and yes, they are producing a lot more than they were 25 years ago. When it comes to construction and to the housing industry, we don't make them like they used to. That's true. We make them better than we used to. And you know what? We definitely there's some trade-off there, right? We're building it safer, we're building it better. And I think that's where the trade-off is.
Excellent. Well, thank you so much. We're right at 2:00. So this has been a great conversation. Thank you so much for your participation. And I really appreciate it. I really enjoyed our conversation.
Thank you as well.
Thank you so much.
Thank
Thanks
you.
for having us.
Thank
Have a good
you.
one.
Bye-bye.